Okay, so one jobs report just changed everything about where interest rates are heading for the rest of 2026. And guys, if you have a mortgage, a car loan, credit card debt, or a retirement account, you need to understand what just happened and what it means for your money. Guys, just back on June 5th, the May jobs report dropped and it blew past every expectation. The economy added 172,000 jobs last month when economists were only expecting around 80,000. That was more than double what was forecasted, and the reaction in financial markets was immediate and dramatic. Traders moved fast. On the CME Fed Watch tool, the probability of a rate hike by December 2026 surged to roughly 68%, up from the 52% before the report even landed. And I just want you to let that sink in. We went from a world where everyone was expecting rate cuts this year to a world where a rate hike is now the most likely outcome, and it happened in a single Friday morning. So guys, I ask that you stay with me all the way through to the end of this video because I'm going to break down exactly what's in this jobs report, what the Federal Reserve is now likely to do at their June 17th meeting, which is just upcoming next week, and what all of this practically means for your financial life right now. Okay, so let's not waste any time. Let's walk through what was actually in the May jobs report because the headline number is only part of the story and I want you to know what the economy added. So, the economy added 172,000 jobs in May. That's the net number after accounting for both gains and losses across all sectors. The unemployment rate held steady at 4.3% for the third consecutive month, which is actually down from a recent peak of 4.6% just back in November. And previous months were revised upward, meaning the labor market was even stronger than we thought going into May. So now let's look at where those jobs actually came from because the composition matters. Things like leisure and hospitality led the way, adding 70,000 jobs. Local governments added 55,000 jobs. Healthcare added 35,000 jobs. And social assistance added 12,000 jobs. And guys, on the losing side, financial services shed 22,000 jobs in May. And that, unfortunately, is a significant number. Air transportation lost 9,000 jobs. Accounting lost 5,400 jobs. And scientific research and development lost 3,900 jobs. So guys, the picture inside the report is one where government-adjacent sectors and service industries are doing the heavy lifting while higher-paying private sector jobs in finance and tech continue to struggle. PNC Bank's chief economist noted that the breadth of this job growth has picked up in 2026, pointing out that in 2025, there were net job losses in all industries outside of healthcare. But in 2026, those industries are seeing net job growth. Now, yes, that is true and an improvement on the surface, but here's the problem that cuts through all of it. Wage growth came in at just 3.4% annually, while inflation is running at 3.8%, and it hit 4.2% for the month of May. That means real wages, what your paycheck actually buys you, are still falling behind. The labor market added jobs, but American workers are still losing ground in terms of purchasing power. So now, here's where things get really important. Because what this jobs report did to market expectations for interest rates is one of the most dramatic single-day shifts we've seen in years. Before the report came out, the entire narrative on Wall Street was about when the Fed would start cutting rates. Coming into 2026, markets were widely expecting multiple rate cuts this year. That story is now completely dead. And here's what the numbers actually show. Before the jobs report, there was a 49% chance that rates would be the same by the December Fed meeting and a 48.7% chance that rates would be higher. And after the jobs report landed, the probability of rates staying the same collapsed down to 27.5%. And the probability of rates being higher by year end jumped from 48.7% to 72%. The probability of any rate cut by year end is now essentially zero. And guys, unfortunately, chances that the Federal Reserve increases rates this year shot up from 25.3% to 52% in just 1 week on prediction markets platform Kalshi. And Goldman Sachs, one of the most influential voices on Wall Street, completely withdrew their 2026 rate cut forecast on June 7th and raised their probability of at least one rate hike. The logic is straightforward, guys. If the labor market is doing this well, the Fed has no reason to cut rates to protect jobs. And with inflation still running hot and oil prices still elevated from the Iran war, cutting rates would be like pouring gasoline on a fire. So the question has officially shifted from when do they cut to whether they actually hike. Now guys, if this video is giving you any value so far, please show some love by smashing that like button, leaving a comment down below, and subscribing. Your support genuinely helps this channel grow, so please guys, show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's move on to the next segment. Alright, so let's talk about what might actually happen at the upcoming June 17th Fed meeting, which is just next Tuesday, because this is Kevin Warsh's very first meeting as Fed chair, and the eyes of every investor, homeowner, and business owner in America are going to be on it. The market is currently pricing in at a 98% probability that Warsh holds rates steady at his first meeting. Almost nobody expects a move in either direction next week. Not a cut or not even a hike. But what everyone is watching for is the language. When the Fed issues its statement after the meeting, the specific words that they choose to describe their outlook are going to tell the markets everything about where rates are heading for the rest of the year. If Warsh removes what's called the easing bias from the statement, meaning the language that suggests rate cuts are still being considered, that is a significant signal that hikes are now on the table. The more probable outcome at the June meeting is a formal abandonment of any easing bias, language that keeps the hike option open, and a data-dependent posture moving forward. And then, of course, there's the Trump factor, which is genuinely wild to watch in real time. Trump has been publicly demanding rate cuts for months, calling Powell names, pressuring the Fed, and nominating Warsh specifically because he expected lower rates. But now the data is pointing directly toward rate hikes. President Trump has consistently advocated for lower interest rates, and his public pressure on the Fed creates a backdrop of institutional friction regardless of what the data shows. If Warsh holds rates or signals hikes, the reaction from the White House is going to be something worth watching very closely. So now, let's talk about the inflation side of this whole equation, because the jobs report doesn't exist in a vacuum. It lands right on top of an inflation situation that was already getting worse before this report even came out. The May CPI inflation report just recently dropped on June 10th, and the expectation was that it would come in at 4.2% for May, which it did. And for context, it was 2.4% in February, which jumped to 3.3% in March, and then hit 3.8% in April. So unfortunately, guys, that is a straight vertical line up over the last 4 consecutive months. And the primary driver of all of that is energy prices. Specifically, again, with the Iran war and the Strait of Hormuz closure, which has messed up oil prices across the globe and has surged over 40% since the conflict began. That is exactly the box that the Fed is now sitting in. You have a jobs market that looks strong, which says don't cut rates. You have an inflation accelerating, which says don't cut rates again, and maybe even hike. But you also have a fragile economy underneath those headline numbers, with real wages still falling, financial services shedding jobs, and households carrying record credit card debt at over 22% interest. Cutting the rates into this inflation spike would be irresponsible, but raising rates into this level of household financial stress could genuinely push things over the edge. And doing nothing while simultaneously continuing to print billions of dollars, which is still happening currently, is, as I'll say plainly, just smoke and mirrors. You cannot fight inflation with one hand while fueling it with the other and expect a clean outcome. Alright guys, so let's bring this whole video all the way together with what all of this information actually means and how it matters to you. What does a 72% probability of higher interest rates by year end mean for your financial life right now? Well, first, if you have variable rate debt of any kind, a variable rate mortgage, a home equity line of credit, a variable rate personal loan, you need to take things seriously right now and look seriously at locking into a fixed rate before any hike lands. Variable rate debt in a rising rate environment gets more expensive automatically and quietly while you're not paying attention. Secondly, for anyone thinking about buying a home this year, I want to be honest with you. The window that briefly opened earlier this year when rates dipped below 6% has unfortunately closed. Rates are now back above 6.5%, and the probability of them coming down meaningfully before year end just dropped again dramatically. Build your home purchase decision around the rate environment of today, not the one that you were hoping for 6 months ago. Third, for your investment and your retirement accounts, understand that rising rates puts pressure on growth stocks and bonds simultaneously, which means the diversification that usually protects you may not work as cleanly in this environment. Having some exposure to assets that historically perform well in rising rate and high inflation environments, things like commodities, real estate, and inflation-protected securities, is worth reviewing in your portfolio right now. And lastly, guys, fourth on my list, just watch the next CPI print extremely closely, because now that we've confirmed the May inflation report to be at 4.2%, things are really taking a turn. Guys, I just want to let you know, this is one of the most important economic moments of 2026, and it is unfolding in real time right now. I want to thank you guys for watching this video all the way through. Please like, comment, and subscribe, and stay tuned for the next videos that I put out almost every other day. And please, in the comments, let me know. Do you think Kevin Warsh is going to hold or hike or surprise everyone next Tuesday with his comments? I'm curious to know what you think. Again, thank you guys for watching this video all the way through. I'll see you guys in the next video.